One of the most important uses of money is as a guarantee against the future. After all, chances are that you don't waste all your money on payday with no mind for how you're going to afford food until your next paycheck. However, putting money in a coffee jar or under the mattress is not the best way to hedge for the future. For one thing, what if the house burns down? Even if such tragedy doesn't strike, money is best put to work for an individual. When an individual puts money to work in hopes of making more money in the future, this is called an investment. Before we go any further, please understand that the word investment has two different meanings for economists. For a macroeconomist who studies the whole economy, an investment with an uppercase I is something made in order to make a firm more competitive. In this mindset, putting money away for the future, something individuals do, is not an investment. Instead, it is classified as a form of savings. This is because investments are those expenses that make something more competitive. Your education is an investment, since it allows you to make more money in the future. Buying stocks and bonds, on the other hand, has nothing to do with your future competitiveness. Instead, you are hoping that those stocks and bonds make money in the future. Therefore, they are savings in the eyes of macroeconomists. Needless to say, this is a bit confusing. However, for this lesson, we are only going to focus on investments as a form of savings for consumers. Let's say that you are an investor interested in adding to your portfolio. You could just leave all your money as cash, but that has one big disadvantage. You don't get to take advantage of any growth opportunities. As a result, inflation slowly eats away at your money. To put this in perspective, the median home price in 1995 was around $150,000. By 2010, it was $300,000, and that's after a major fall in housing costs in 2007. Had you been saving for a house, simply putting money under a mattress would have resulted in you missing out. This erosion of the value of money is called inflation. Luckily, there are a number of investments that allow individuals to beat inflation and even make more money. Open up any financial newspaper or magazine, and you are immediately hit with a wide variety of investment options. However, at their core, these boil down to two main classes: stocks and bonds. Stocks offer a share of the ownership of a company, whereas bonds are a way of loaning a company money in exchange for interest. Of the two, stocks have considerably more earnings potential, but bonds have much less risk. Throughout economics, and finance especially, you'll notice that the higher the earnings potential, the higher the risk. Stocks make up the vast majority of investments, so let's say that you are interested in purchasing stock. In the past, you could choose between thousands of companies. Now, you can choose to own stock only in those companies, or you can choose to buy funds that buy some, many, or all of the stocks on the market. These range from mutual funds, which buy a preset ratio of pre-chosen stocks, or an exchange-traded fund, that is a basket of funds that can be traded like a stock. You can even buy an index fund that owns bits of every company that is traded on a given exchange. That's a lot to try to understand, so let's look at it from the perspective of food. If you were preparing to set your menu for an automated food delivery service, putting all your money in a given stock would be akin to only ordering pizza every day. Some days the pizza will be great. Other days the pizza will be cold. A mutual fund would be agreeing to a set slate of meals, but you don't know what day they will arrive. It could be that you get a delivery of sushi on a day when you are really hungry, or get a pizza on a day when you are sick. An exchange-traded fund would allow you to remain on the mutual fund meal plan, but you are paying someone to predict when a delivery of tuna casserole is coming so you could sell it in time to avoid the upset stomach. Finally, an index fund is like getting a sampler platter every day. Sure, you miss out if there is steak one day since you only get a little piece, but you also aren't stuck eating a whole plate of tuna surprise. Bonds, on the other hand, work in a completely different fashion. Like I said earlier, they are simply a loan to the company. You get paid a set interest rate every year. While they don't pay as much as a stock, typically they are crucial to the economy. In fact, the U.S. government finances much of its operations through the sale of bonds. Therefore, to continue the food analogy, by purchasing a bond, you have agreed to simply get cheese pizza every night, but it is guaranteed to be hot. You avoid the tuna casseroles, but you also avoid the nights when there is steak on the menu. Bonds can also be incorporated into mutual funds or index funds, which means that instead of just a standard pizza, you may get half a pizza and half a fried chicken, for example. Of course, there are other forms of investment that are available at your bank. For starters, you could put your money in a savings account. It would be relatively easy to get to, but would pay very little in interest. On the other hand, a certificate of deposit, often called a CD, would allow someone to earn higher interest, but they couldn't get to the money as easily. This is another golden rule of finances. The harder it is to get one's money, the higher the rate of return is likely to be. Banks and investment companies publish the interest rates that have been paid in the past, and except for stocks, expect to return in the future. However, these aren't as straightforward as they seem. Sure, that bank may be offering a 3% return on a CD, but is that really what you can expect to gain? In short, yes and no. Yes, at the end of the time period, your money will nominally rise by 3%. But what good is that if inflation or increases in the cost of money drive up prices by 3%? Essentially, you will have earned an interest rate of 0. Therefore, investors have to calculate the real interest rate of an investment. Luckily, the formula is relatively easy. Real interest equals the rate given at the financial institution, called the nominal rate, minus the rate of inflation. For example, if you find a bond that pays 5% interest and the inflation rate is 1%, the real interest on the bond is 4%. Investments provide an avenue for individuals to save for the future without stashing money under a mattress. Banks, companies, and even governments can offer investment routes for people seeking to save. These come in the form of stocks, bonds, CDs, and savings accounts. Typically, stocks have the highest risk, but the highest chance of return. Conversely, savings accounts have little risk, but little chance of reward. Finally, the real interest rate is calculated by subtracting the inflation rate from the nominal rate provided by the financial institution.